This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying, looking for the downloads. Okay, Eric, let's start off with your thoughts on the equity markets.
Well, Patrick, the market gapped higher on the Tuesday evening futures reopen after news broke that President Trump said, okay, he didn't really mean it. He's not going to fire Fed Chairman Jay Powell after all. That left a gap on the S&P E-mini futures chart on the June contract down to about 53.30 that probably needs to be filled. I see plenty of room for a big move in either direction here, but it's downside risk that I'll be hedging. The only thing that's completely clear here is that President Trump is on a mission that does not involve showing his cards. So the advice we've heard to take President Trump seriously, but not literally, definitely comes to mind. And it's also clear that President Trump is not afraid to break things in order to achieve his goals. So look, if what he does next is to kiss and make up with several different trading partners over tariffs, well, that could easily take us back to new all-time highs. Likewise, another round of tough love from the president toward those same trading partners could easily take us down to 4,000 on the S&P. And I don't think we're going to get any warning from the White House as to what their plans are or what they're intending. So as we've said all year, volatility will continue to be the theme for 2025.
So, Eric, I want to break this down into answering some simple questions. For instance, we just want to step back and reflect on what is the primary trend. And the primary trend at this point is down. And we are below the moving averages, sequences of lower lows and lower highs. Almost all rallies end up meeting resistance and start rolling over. And so there is no evidence that we have begun a new bull phase in this market. Now, we do get these bear market rallies, and they can be violent. For instance, right now with the volatility index, the VIX on page 3 there, being at 29, those are daily implied ranges of pretty much close to 100 S&P points and 220 S&P point weekly implied ranges. Point being that the market swinging several hundred S&P points higher and lower is just par for the course in these heightened volatile environment. So what is going to be the driver of the next trend? And while the focal point is on Trump, like you suggested, I do believe that we're coming to a really interesting moment in the earnings cycle and the jobs numbers coming up. And so here we have a market that is below its fib zones, below its moving averages. We could easily still have a rally toward that 5,600 area where the 50-day moving average is. But we do have the major Mag 7 stocks all coming up. So Google's up to bat. We already saw Tesla, and then we have 4 of the other major Mag 7s all reporting next week, all within almost 24 hours of each other. And so we're going to get a lot of clarity on earnings at that moment. So on page 4, I have that Mag 7 ETF just showing how these Magnificent 7 are trading. And what we see is that there is a very distinct distribution cycle, still incredibly weak price action. The bounces in the Mag 7s were far weaker than what we have seen in the broader market. This only confirms that the primary trend is the bearish one. But this is where the earnings will play a pivotal role. What if everyone is over worried about this, and then we have a relief rally that happens almost the way Tesla popped on its earnings? Could that drive, let's say, the Mag 7 ETF back to 46, 47, even hitting 50 under the right circumstances? It could. that could temporarily alleviate the S&P to rallying above 5,600. Maybe we even see 5,700 or more on the upside. Those are bear market rallies. Now, I want to reference what a bear market rally is by simply observing the way that, for instance, past bear market rallies behaved. For instance, let's just go to the most recent bear market of the 2022 period where the stock market had a material decline for close to a year. When that short-term low first came in March of 2022, there was a trough to peak rally of about 22 days. And then it didn't take, then the breakdown below the 50-day moving average that really resumed the selling didn't happen until 45 days after the previous low. The point is that bear market rallies can last a month, sometimes 2 months. Even in 2008, once the January financial crisis started, there was almost a 3 to 4 month bear market rally before the real big breakdown started to happen. And so we're in the midst of some sort of a bear market rally. And that it can still actually make short-term progress higher. To me, this thesis is still valid so long as the market stays at or below this kind of 5,600, 5,700 area. We'd have to rethink the entire narrative if the market started doing more bullish things than that. But earnings and jobs are all going to play a really important thing. The other observation I wanted to make is on page 5, I have the Russell 2000 Small Cap Index. And I just want to highlight how incredibly weak the rally has been in the small caps. On a relative basis, it's probably as weak as the Mag 7s, but the S&P 500 was much stronger on the bounces. And to me, seeing some stability in the small cap space, I think, is really important in order to see a potential major bottom in the stock markets and a turning point. Like when green shoots start to appear for the turnaround, you have to believe that we'll start seeing some sort of responsiveness in these small caps, and that's simply not evident. The last thing I want to leave our listeners with is just where is the failure point? And that was, I think, very clearly defined earlier this week when we were trading down near 5,100. And at this stage, if we have a breakdown below 5,100, especially if it's in the post-jobs number period into next week, then the downside window would reopen for another leg lower. At this stage, I don't believe that this week will usher that breakdown. Odds are pretty reasonable that the bear market rally can still continue and several hundred more S&P points upside will appear, but that primary trend down is still there, and this is still a bear market rally, and inevitably we will get another leg down, and that's the puzzle we're going to try to solve here in the weeks to come. All right, Eric, let's move on and touch on the dollar here.
After testing a 97 handle on Monday, we're bouncing back up toward the top of the channel, but the trend is still down, and it's still strongly down. I don't see any reason to expect it to reverse.
Well, Eric, in my mind, the U.S. dollar is incredibly oversold on the short term. Now, it may be the beginning of a bigger U.S. dollar bear market, but we are now way overdue for a reactionary bounce, some sort of a retracement, a reflexive rally from the fact that the Dixie lost 12 points essentially in a span of 3 months. And so now that we have seen this kind of selling, a rally on the dollar index back to 101 or 102 would be par for the course. But the bigger question becomes, will it fail along its 50-day moving averages? Will the consolidations roll over for another round of selling in the late second quarter, if not the third quarter of the year? Those are all puzzle pieces that we're going to try to solve. On page 7, I have particularly the U.S. dollar yen chart. And here I wanted to highlight simply a very key support line that could very very well define why we're going to be bouncing here sometime soon. You can see that US dollar yen has traded right back down to that 140 to 142 range down at the bottom, a support level that has held both in 2023 and in 2024. It doesn't mean it's going to hold long term, but often when you get to a major support like this, with this kind of oversold condition, is where you get the reactive bounce. And this is exactly what we're looking for in the dollar. You can really see it far more evident here in the US dollar yen. And this could easily be bouncing back to 146 or 148 on the upside before we see another round of US dollar bearishness. Since we're on currencies, the last thing I wanted to touch on here is the cryptocurrency, looking at Bitcoin. And particularly, I wanted to highlight the fact that we've spent almost the entire year trading below the 50-day moving average. And back in January, it crossed below the 50-day, and we've been pretty consistently in a downtrend throughout the first part of the year. Now, all of that selling has actually held Fibonacci retracement zones and fits the characteristics of a wedge consolidation. So with this breakout that happened this week, that got it back above this 50-day moving average, it certainly puts it on the radar as to whether or not Bitcoin is got the potential to start a new bull trend. There's a lot of work that still has to happen. A couple day rally is not enough evidence to say that it's definitively a new bull market. But what I'll be looking for in the next week is whether or not Bitcoin consolidates to the 50-day moving average. All dips are being bought, whether the price action continues to confirm that there's some accumulation here. And if we start seeing price action clearing 95,000 and taking a shot at 100,000, then that could really start to build on itself into a new bull trend. The failure point, of course, is a breakdown below that 84,000. So we've got a wiggle room for Bitcoin to pull back 5,000, 6,000, 7,000 and still be bought on dip in this trend. So let's move on to crude oil here, Eric. What's your thoughts?
News of some OPEC members pushing for an accelerated production increase appears to be behind the sudden failure of the rally, which, until that happened, looked like it might have some legs. So we're going to have to watch the news flow for a tell on what comes next for the market.
So, Eric, in my mind, when I look at crude oil, I ask the simple question, what is the primary trend? And the primary trend definitively is a bearish downtrend. And we've been consistently seeing oil distribution for over a year. Every rally failing, breakdowns to lower lows now, everything it has those characteristics. Now, in technical analysis, when you have a major support line established, like we did around that $66, $67 area for close to a half a year, when you have a support line that gets broken, then when the market rallies, what was previously support now acts as overhead resistance. And so now we had crude oil basically approach $65, and that now is overhead resistance. Conveniently, the 50-day moving average is tucking in around $66. So you now can very clearly see where the rejection points in crude oil are. If we see that crude oil cannot beat this huge overhead resistance level, then anticipating another technical breakdown for a minimum, a double bottom retesting at 58, but also still entirely possible that we can go into the low 50s for a short trip as that prevailing downtrend just continues to squeeze the longs and force some margin selling and so on. Nonetheless, it's a primary downtrend that still is very challenging. On page 10, Eric, we got the gold chart. What are your thoughts here?
Well, Patrick, as you said last week, we've definitely entered the parabolic phase of this gold bull market, and that's not good for the gold bulls. I'm reminded of an interview, must have been, 15 years ago. I heard Jim Rogers being interviewed by a young and eager new podcast interviewer, and the gold market had just been up, 20% or so in just the last few weeks. And this interviewer said to Jim, do you think there's room for the gold to rally another 20% in the next few weeks? And Jim said, God, I hope not. If it did that, I'd be forced to sell it, and I don't want to sell it. Well, that's definitely apropos for today's market, because there is no doubt in my mind when you get into a parabolic move like this, it's going to end in tears for the longs that get suckered in at the top of the market just before the final blow-off top obliterates them. And all of a sudden, before you know it, a few days later, we're trading hundreds, if not thousands of dollars lower. But whether that final blow-off top comes at 3,600 or 8,600 is anybody's guess. And President Trump is clearly not showing all of his cards. So we don't know how much he's willing to break and how many foreign leaders he's willing to piss off and how far he's willing to piss them off. Those are the things that are going to decide whether that final blow-off top comes at 3,500, as already happened, or at 8,500. So, my guess is this is probably not over yet and higher numbers are still to come. But my real point is this is a very high-risk trade from here, since it's nearly certain to eventually blow off and reverse hard to the downside eventually, but the timing of when that final top comes is going to be nearly impossible.
Well, Eric, we talked about in last week's episode this parabolic acceleration to the upside, and we've seen that. Now we hit a short-term swing high at 3,500, and we saw a pretty violent correction. And the one I want to talk about the nature of these corrections. First of all, gold's implied volatility went from trading in the mid-teens, in the 15-16% range, to now jumping near 30%. That creates a daily implied range of about $60 an ounce. So what we have to immediately acknowledge is that gold is just going to be very volatile, higher and lower in almost every daily move. And now we did have a very sharp sell-off, but this is not uncommon because often during parabolic rises, the magnitude and velocity of the rise on the way up, the corrections often have very similar velocity to the downside and range. And so seeing a 100+ point pullback is just normal in these kind of conditions. Now, what is going to be really critical here in the very short term is whether the 3,200 level holds and whether this correction only lasts a few days. In these very accelerated moments in gold, when you have very short-term corrections and they get bought on dip, then the next leg higher can still be this extraordinary rip higher. And we could see even 36, 37, 3,800 or more on the upside within the next week. But if it is a swing high, if this is the short-term high, I mean, obviously a number of technicians observing the very overbought conditions of gold, and that's very typical during parabolic rises. But the question in my mind is the top in or not? And to me, if 3,200 is given out, and more importantly, if the selling persists for 3, 4, 5 days, rather than just being a 1 or a 2 day pullback, will mean that the upside momentum is dissipating and the chances of a top become much greater. And so if this is going to keep bulling, it shouldn't take more than a couple of trading sessions to find out. And if we're already in the middle of next week or going into next week's jobs numbers and gold is not making new highs, odds are pretty good that that's a swing high. And then we're talking about testing 3,000, and we could see a prolonged consolidation into the summer as a short to intermediate high maybe there. That doesn't make me bearish gold or think that we're going all the way back to like 2,000 or 2,500. But if we do see that there's a swing high, then it could mean that gold is just going to find and settle into a trade range and consolidate there deep into the summer. And finally, Eric, let's just touch on uranium. What are your thoughts?
The primary trend is definitely still down, but we're finally seeing what might be some green shoots of hope that maybe we're finally trying to grind out a bottom here. It's going to depend, though, on what happens to the S&P, but at least on a relative performance basis, the URNM divided by the SPX, that's the relative performance chart, is finally starting to turn up after double bottoming. We're through the short-term moving averages to the upside now on most of the charts in the sector, but we're still below the 50-day moving averages. So there's still more work to be done before we could say that there's a sign of trend reversal in the works. I guess as optimistic as we can get for this week is it looks a little better than it has for the last several weeks. But we've seen plenty of false signals before where it looked like the market had bottomed, thought, okay, surely that's got to be the bottom, and it just turned out that we ended up taking out new lower lows after that. I really think broad market risk is still the big elephant in the room. If President Trump does something further on the tariff front that upsets everybody and we end up at 4,000 on the S&P, we're definitely going lower on uranium. But I do see a few green shoots here that maybe there's signs that we're trying to grind out a bottom if the broader market holds up as well.
Well, on page 11, I have the chart of Sprott Physical Uranium Trust. Particularly, this is in Canadian dollars. But what we continue to see is the spot price of uranium continue to be incredibly stable, but we continue to see distribution in the Sprott Physical Uranium Trust, creating a bigger discount as we continue to see retail and hedge fund selling pressure just force this ETF lower. What we can observe is that uranium itself has stabilized. The bigger question, of course, is this where uranium will bottom? And is this low enough? Well, as a uranium as a commodity price, we probably are very close to the lower boundaries of where this will go. But the second question is, well, if these are going to be where the lows are, how long will it take for it to start being bold? And this is the challenging part, is that even if we identify that this is a short-term low and this is where the intermediate or longer-term low may actually come in, the question is, do we have to wait 6 months for it to start doing anything bullish? And so right now, I'm very neutral on this. I like the price level. I think this is levels where we're going to ultimately see the lows. But the question is, how long are we going to have to wait for this to start turning up?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.